This is the stage in life where you probably have more years of work behind you than you have in front of you. We imagine that your mindset has started shifting in your 50s. You have to start thinking that it's no longer about how you are going to launch this plane, but how you are going to start landing. You are entering the next phase of your life, as we always say, because we believe it is important and worth remembering. And you will measure twice, cut once, and then undergo stress testing. Many of us are relying on do-it-yourself anecdotal information because we assisted you in this area and told you to save 20-25-25. You already use things like the 4% save withdrawal rate and other things to help you figure out if you are saving enough and what retirement would look like. However, when you get into your 50s, this is probably the point where you ought to start creating a true plan and not just an anecdotal benchmark plan that might get you closer to your retirement. We know that we have talked about this idea of mastery and expertise and how it normally takes 10,000 hours to master something well. If you are between 55 and 64 years old, you still have time to boost your retirement savings. Whether you are planning to retire early, late, or never, having an adequate amount of money saved can make all the difference, both financially and psychologically. Your focus should be on building out or catching up if necessary. It is never too late to start saving, but the last decade before you retire can be especially crucial. By then, you will probably have a pretty good idea of when you want to retire. And more importantly, you still have time to make adjustments. If it normally takes 10,000 hours to master something, then it is no different as you prepare for retirement. Perhaps you should put in 10,000 hours to figure it out. Or maybe it is not about retirement, but how to shift from being a saver to being a consumer. That's probably going to take time. And in your 50s, you probably ought to start thinking about what it looks like and how it'll change as we navigate through life. If you discover that you need to put more money away, consider these time-honored retirement saving tips. Step 1. Fund your 401k plan. If your workplace offers a 401k plan or a similar plan, such as a 403b or 457, and if you aren't funding yours to the max, now is a good time to rev up your contributions. Not only are such plans an easy or automatic way to invest, but you will be able to defer paying taxes on that income until you withdraw it in retirement. You may also be in a higher marginal tax bracket now than you will be during retirement. This means that you will be paying a smaller tax bill when that time comes. This also applies to traditional 401ks and other tax advantage plans. If your employer offers a Roth 401k and you choose that option, you'll be able to pay taxes on the income now, but be able to make tax-free withdrawals later. You can contribute to the maximum amount to your plan, as it is adjusted every year to reflect inflation. Step 2. Rethink your 401k allocations. Conventional financial wisdom says that you should invest more conservatively as you get older. Invest more in bonds than in stocks. The reasoning behind that is that if the stock market takes a tumble, you won't have many years to take a tumble, and you may be forced to sell at a loss. Just how conservative you should become is a matter of personal preference and risk tolerance. A few financial advisors would recommend selling all of your stock investments and moving into bonds, regardless of your age. Stocks will provide growth potential that bonds do not. The point is that you should remain diversified in both stocks and bonds, but in an age-appropriate manner. Step 3. Think about adding an IRA. If you don't have a 401k plan at work, or if you are already funding yours to the max, Another retirement investing option is an individual retirement account. The maximum you can contribute to an IRA in 2023 is $6,500, plus another $1,000 if you are 50 or older. IRAs come in two varieties, traditional and Roth. With a traditional IRA, the money you contribute is pre-tax and deductible in that year. A Roth IRA can get you a tax break at the other end in the form of tax-free withdrawals. Note: married couples who file their taxes jointly can often fund two IRAs, even if only one spouse has a paid job. This is known as a spousal IRA. Step 4. Know what you have coming to you. The amount of money you need to save depends on your other sources of retirement income. Once you have reached your mid-50s and early 60s, you can get a much closer estimate than you could have had earlier in your career. When it comes to a traditional pension, if you have a defined benefit pension plan at your current employer or a previous one, you should be receiving an individual benefit statement at least once every 3 years. You can request a copy from your plan's administrator once a year. The statement should show the benefits you have earned and when they fully belong to you. It is also worth learning how your pension benefits are calculated. Many plans use formulas based on salary and years of service. If you are in a position to benefit, you may benefit more from staying on the job longer. Once you have contributed to Social Security for 10 years or more, you can get a personalized estimate of your future monthly benefits using the Social Security Retirement Estimator. Your benefits will be based on your 35 highest years of earnings, so they may rise if you continue earning. Another important thing: although you can take penalty-free distributions from your retirement plans as early as age 50 or 55 in some cases, it's better to leave the money untouched and let it keep growing. Step 5. Don't touch your retirement funds. After the age of 59, you can now begin to make penalty-free withdrawals from your traditional retirement plans and IRAs. With a Roth IRA, you can take out your contributions penalty-free at any age, but not your earnings. There's also an IRS exemption called the Rule of 55, which says that workers aged 55 and older who lose their jobs and leave their jobs do not have to pay the early withdrawal penalty on their retirement plan distributions. It's complex, and it would be best to talk with a financial advisor if you consider using it. However, just because you can make withdrawals doesn't mean you should, unless you absolutely need the cash. The longer you don't touch your retirement accounts, the better off you are likely to be. However, if you were born in 1951, 1959, or 1975, you have to start taking required minimum distributions at age 73. If you were born after the 60s, you have to start taking them at age 70. This is an increase from the previous age of 72. Step 6. Don't forget about taxes. Do not forget that not all money is yours to keep. When you make withdrawals from a 401k plan or traditional IRA, the IRS will tax you at your rate for ordinary income. If you're in the 22% bracket, for example, every $1,000 you withdraw will net you just $780. You may want to plan ahead of time to keep more of your retirement funds in order to relocate to a tax-friendly state. Step 7. Do you know where you are going? You know where you've been, but do you know where you are truly going? Changes are coming into your life, and you know very well that you need to think about this. We love a good action plan that you do not take for granted. You need to start thinking about your happiness and what you can do outside of work as you slowly transition to a new stage in your life. When we asked retirees, there were a few things we didn't mind sharing about their accomplishments. They have transitioned to their retirement stage and it has been successful. However, there are some people who didn't have a smooth and seamless transition. If there is one thing that keeps coming back, it isn't about money or anything else. People are more likely to make a smooth transition to retirement if they have a clear idea of what comes next. The more time and thought you put into developing it, the more likely it is that you will successfully move through it rather than waking up every day and not going to work. Step 8. Simplicity is your friend. When you are in your 20s, you are aspirational about creating your own wealth. You would simply daydream about how it would be cool to own a couple of rental properties. If you have a bunch of K1s from your businesses and you just think that it's going to be awesome doing all the complicated things. Fast forward, you are now in your 40s. When you reach your 50s, you start thinking, how did my life get so complicated? And crave a simple, easier life. Things aren't going in all different directions, and this is something we want people to hear. Even if you are not in your 50s yet, you can benefit from this idea. If you have a bunch of stuff from prior jobs or commitments, do not have accounts all over the place. Try to consolidate and eliminate the noise as much as possible. We would like to talk about this because we are always surprised when we see people in their 50s and 60s who are carrying heavy loads of debt. So here goes step 9. Eliminate debt. One of the best ways to simplify your financial circumstances is to eliminate debt. We have talked early on about this with people who are in their 20s and 30s. However, when you are in your 50s, you are transitioning towards retirement, and we want everyone to remain completely debt-free. Thank you so much for watching Legend Finance, and please do follow our channel for more of our content. Also, don't forget to like and subscribe, and we will see you all in the next video.